Okay, let's go. Thank you, everyone, for joining us. It's been an absolute pleasure bringing monthly webinars to you throughout 2020. We've got a brilliant session in store for you today with our special guest, Dr. Andrew Wilson, who we also spoke to back in March when things were much more uncertain than what they are today. And we'll follow with a live Q&A session. So please stick around for that, and I'll cover all of your pressing questions in our Q&A. Three quick things just to kick off with before we start. Love to make these sessions interactive. So anytime you have questions, please use the chat box. Abby's here helping me on the side. We'll filter those through, and I'll cover off as many of those at the end as possible. As I said, we'll make it interactive. We'll use chat to gather some feedback and insights from you as we go. So please share, please interact. That would be great. And if you do have to jump off early for whatever reason, then we will email you a replay of the webinar today. Now, as I said, this is our last webinar for 2020. We'll be back in February, but in the meantime, we are still keen to help as many investors as possible gear up for a big 2021. The fundamentals that drive property are in a fantastic position for us. I have no doubt that we'll look back in 10 years' time and say what happened through 2021 was a once-in-a-decade opportunity, and I'm looking forward to sharing all of those details with you. But so that we can help as many of you take advantage of the market conditions as favourable as they are right now, you may have seen that we are offering all of you a personalised strategy session with one of the experienced investment consultants in our team. They are all investors themselves. That appointment is not to look at property, it's not to buy anything, it's not to sign anything. It comes at no cost and no obligation. It's just an opportunity for us to be able to help you look at your individual situation and share some more fundamentals around investing. There's no, as I said, no cost, no obligation, just to reiterate. That's not the way that we roll, purely education in that session. So think of it as a Christmas gift from us. If you'd like to take advantage of that, the link is in the chat box. Please click on that to take up the opportunity for your personalised strategy session, as I said. Now, just to kick things off, as I said, we've got the second most number of attendees this year for today's webinar, right behind the Andrew Wilson session from earlier in the year. So Andrew's clearly popular, and why not with his amazing insights. A quick poll to get things started, just so we can get a sense of where you are on your investment journey. And I can make sure that we've got something in store for everyone. So use the chat box. If you could reply to that, let us know whether you're just starting out, whether you've got a small portfolio, or an experienced investor really looking to take advantage of the market conditions right now. I'll give you a few seconds for that. Wonderful. Thanks for all of those insights. If you're still going through it, please continue. But as I said, we've got some fantastic information to take you through. I'm really excited. So let's dive in. Okay. For those of you who haven't met me, so to speak, before, Michael Beresford is my name. I'm the Director of Investment Services here at Open Corp and one of the 4 partners in the business. I've been investing myself for 17 years. And the other guys even a little bit longer than me. And the whole reason we started Open Corp was because our family and friends were curious about what we were doing and wanted to share in the same formula and secrets to get the same results that we've achieved over the years with our own portfolio. So what I'm going to be sharing with you today is a deep dive into the fundamentals that drive property markets. We're going to be getting some extensive insights from Dr. Andrew Wilson, who is an expert property economist in Australia, highly sought after in the media. And when you hear the insights that Andrew has and what he had to say earlier in the year, you'll understand that all of those predictions and insights did in fact come true. We'll drill into why that's occurred, not just the what, but the reasons behind it, so you can understand exactly why we're seeing the potential that we have moving into 2021 as property investors. So to begin, when we sit down with you for your individual strategy session, we focus on what it is that you want to achieve and help you understand how our strategy can help you get there. So what I want to start with very quickly today is a brief snapshot on why, who OpenCorp are and exactly what we do. Okay, so I guess fundamentally, we are your property investment powerhouse. Okay, we are your mentors over the journey, and we want to be working with you long term to ensure that you achieve the financial goals that you have. One property is better than none, don't get me wrong, but one property is not going to allow you to be able to create the kind of financial freedom and wealth creation required to achieve the goals that most Australians have. I want to be really clear. My presentation style, it'll be pretty direct. There is so much to get through. I could talk about this stuff for 5 hours and we probably still wouldn't cover it. I'm trying to pack it into 75 to 80 minutes. So if it feels like we're working through a bunch of bullet points in rapid succession, that's exactly what I want to do today, to share as much information with you as possible. Everything that I'm talking about is exactly what Cam, Al, Matt and I have done ourselves, and it's the same process that we help our clients execute. So when we say that we're mentors to help improve your performance, we've got the track record. We've been doing it for over 20 years. I'll share that track record with you, and you'll see how we've been able to beat the market based on the formula that we have. So you can sit back and take in all of this rich information I'm going to be sharing with you, so you understand who we are and what we do very quickly. We basically help you at every single step along your journey. We are not developers, we are not builders, we're not real estate agents, okay? We are not selling our own stock. What we do have is an in-house research and acquisitions team doing all of the analytics around our property selection process, okay? It makes no difference to us whether your property is here or here. That will be specifically tailored to your personal situation, your borrowing capacity and your cash flows, okay, to get the best outcome for you. Secondly, we will structure the finance. We have finance in-house. We'll ensure that we get the right kind of finance and loan structuring so that you're not paying more on your mortgage, that you're understanding how we can unlock equity, but most importantly, making sure that your castle, being your own home if you have it, is safe and secure. I learned that the hard way myself. We teach you how to do it more effectively. We've got property management in-house as well. You don't want to be dealing with call-outs at 2 in the morning. Property management fees are tax deductible. Have the management done for you. We want this process to be as enjoyable and low stress as possible. But really, the way that we differentiate is to help you get outcomes long-term. Our Mentor for Life program is not about just education today or education in your individual strategy session. It is long-term education, and the analogy that I like to use is your school journey. You don't turn up to day one of prep trying to pass year 12 maths on that first afternoon. It's just not possible. We can't teach you everything up front. But we look at the fundamentals and we hold your hand, guide you and mentor you over your journey on more and more strategic and specific information to ensure that you're going to achieve the financial goals that you've got. We manage the whole process for you. Everyone's time poor these days. We do it all for you. And we're so confident in our process that we de-risk the process through guarantees and protections as part of our service offering. There are so many people that you have to deal with through this journey, not with OpenCorp. You have single points of contact and a relationship management approach. And finally, the secret to ensure that you achieve those financial goals is our strategic portfolio management. Consistent reviews of your portfolio, your borrowing capacity, tweaking your loans. How can we save some money? The best way to structure and optimize that portfolio for cash flow, as well as exit strategies to get your hands on the cold hard cash at the end of the day. So that's what we do. Think of it as an end-to-end service, outsourced delivery with guarantees and protections. We also believe in having some fun along the way as well. A range of pictures from client functions, our client nights. We had over 350 clients on our client night about a month ago, getting all of the kind of market insight information, forecasts for 2021, and fundamental game changes that investors need to be aware of to maximize their opportunities moving forward. For those of you that have heard me talk before, you'll know that one of the things that I am really passionate about is helping people understand the fundamentals that drive property markets, not the headlines that sell papers. Okay, just have a think back to what the media commentary was at the start of COVID-19 through March and April with regards to market crashes, with regards to vacancy, with regards to unemployment, and so on. And just ask yourself, how many of those headline predictions actually came true? What you might be interested to know is that we did a 6 to 8 week weekly series of educational videos for all of our clients, providing commentary on the fundamentals on what we expected to happen over the next 6 to 12 months and why. And all of those predictions and information happened when the headline information did not happen. That's what we're going to be going through today. And the best place to start is these 5 fundamentals that actually influence property markets. Now, I realize why journalists can't write about the stuff I'm about to share with you, because unless it's of interest, this stuff is not going to sell papers. Their interest and their motivation is to create a headline that gets clicks and sells papers and magazines. Our interest is getting results and providing great service so that our clients come back and they add to their portfolio, getting their next property and their next property through OpenCorp, and that they're telling people in their network about who we are and what we do. There are my cards on the table. In the first 10 minutes, you can sit back and you're not wondering about what our vested interests are. Our vested interests are getting results. So let's dig into the 5 influences of property markets. The first is interest rates. Okay, fairly obvious. However, affordability has improved 40% in the last 4 years, given the interest rate reductions that we've had. There is no clearer way to put it, but with interest rates at record lows, any well-chosen investment property in line with our strategy will be paying for itself from day one. So as I'm going through the rest of these fundamentals, just think to yourself, are all of these things going to be driving growth in property? And what's my risk? If the properties are paying for themselves, what we need to make sure we are doing is having tenants in the property 52 weeks a year to ensure that the properties are paying for themselves and the growth will occur over the years to come. I'll get into interest rates and unpack this in a little bit more detail as we go. The second fundamental is effectively demand, and that is in the form of population growth, in addition to overseas migration. Now, I'll give you some data later on with regards to overseas migration, what's reported, and what the specifics actually are. That in itself will be worth waiting for. The other half of that equation with demand is supply. The amount of development and building approvals in terms of stock coming onto the market, and that typically shrinks during periods of downturn. So provided we have demand ongoing, we have reduced supply, we know what happens to prices. I will expand on lending policies in a fair bit of detail. There are some game changers on the horizon to happen in the next few months with regards to extra borrowing capacity that will bring extra demand and exponential capacity into the market, that will position investors already in the market with a foundation to be able to see significant growth moving forward. This is probably the biggest game changer in the last 5 years with regards to house prices. Finally, government infrastructure and spend / stimulus. There have been numerous announcements since June with stimulation for the housing market that we can take advantage of, whether it be directly or indirectly. But there is no secret that the government's go-to strategy of supplying support to the housing industry, to the construction industry, to the retail industry, because of the economic flow-on effects, has been popular in the past, and it's continuing to be popular today. So if you take nothing else away from today, please focus on these 5 key things as the fundamentals that drive property markets, not the headlines that sell papers. So if you haven't been following us all year and you're new to our webinar series, welcome along. That's great. As a quick recap on what we did say, going back to March, in our interview with Andrew Wilson back then, these were the things that we said would happen. We said that there wouldn't be a market crash because there wouldn't be an oversupply of properties on the market that is required for prices to drop significantly. We said sales volumes would drop, but that would be to a level where it met demand. We said apartment vacancies would increase purely because of the type of tenant that lives in an apartment, the industries that they typically work in, plus the saturation of investors within apartments. It's a very, very different story within suburban homes, and that has absolutely remained the same. We're actually starting to see dramatic increases in demand based on vacancy rates coming down, and I will expand on that with some data and graphs for you shortly. We said, if anything, there may be a small drop in the median house price. That doesn't mean that every property loses value. It just means that the top end of the market is impacted because there are fewer transactions, so the middle value shifts backward. I'll explain that fully as we go. We talked about how to mitigate vacancy risk and the fact that when you target family tenants within your investments, they are a far more stable type of tenant than a single or two friends, for example, living in the same property. We implored our clients to focus on their long-term strategy and that long-term decisions are not influenced by short-term circumstances. That feedback has been heeded well by our clients. We've had nearly record volumes of our clients duplicating this year and adding to their portfolio, which will absolutely pay dividends in the future. So these are all the key things that we said. Why did we say that? Well, because of these items here. Uncertainty purely means that people sit on their hands. So fewer property transactions means that we don't have that large oversupply on the market or that forced selling. And part of the reason for that, point 3 there, the banks and governments have a vested interest in the property market remaining strong, as we've seen, with the kind of assistance that the banks have provided with deferred repayments and the stimulus that the governments have provided, not only to keep the unemployment rate as low as possible, but to stimulate the housing sector. We've seen fewer international students coming into Australia with border closures. They typically tend to reside in the student accommodation and apartments, not the kind of target market that we're looking at, which is much more stable at an affordable rent. Okay. Not only that, a family tenant will typically have a very strong single income or multiple incomes within the family that just reduces the risk of them not being able to pay the rent, falling into arrears, and so on. We manage over 1,150 properties as part of our property management team. There have only been a handful of, less than 2% specifically, of our tenants that we look after that have required some kind of repayment adjustment due to COVID hardship. So well and truly under the Australian average there. But on the upside, we were talking about that after any downturn, there is a significant upside, that rebound would be swift and significant. I've got some data on that, and that's exactly where we see the market moving forward into 2021. So that's the opportunity summarised. Remember, all of this is what we were saying when there was a period of significant uncertainty about 8 or 9 months ago. All of that has come to fruition, and the reason it has is because of those fundamentals that I talked about 10 minutes ago. So I mentioned that we talked to Andrew Wilson back in March to get his insight and economic-based insights into what we thought was going to happen during COVID. All of that exactly happened. So we thought, well, what better way to finish 2020 than to talk to Andrew again and get his insights into what he thought was going to happen moving forward. So these are all of the points that we mentioned in our description of what today's webinar would cover. Without further ado, let's get into the interview with Andrew and hear what he's got to say. Well, hi everyone. Thanks for joining us today. We've got a really special guest with us, Dr. Andrew Wilson. Andrew is the chief economist for My Housing Market. I'm sure the name Dr. Andrew Wilson will probably be familiar to a lot of our viewers. He's a regular sought-after media commentator, very prominent within the property industry, and was the ex-chief economist for the Domain Group. So often quoted in the media. Andrew, how are you going?
I'm fine, Michael. Yes, thank you very much for that introduction. And it is good to be here in more ways than one. Of course, we're feeling a lot more optimistic in terms of the outlook, not just for the property market, but most importantly, of course, for the health outlook. And I also think that the economy is looking a lot better also than many predicted. So we can afford to be, a little bit optimistic about the outlook. And I guess it's interesting that the last time we spoke was 6 months ago. And we were really in that veil of uncertainty then, weren't we, Michael? It was very tough times.
Indeed, there's a lot of juicy detail and data that I'm sure you've got to share with everyone. But it's amazing how quickly time flies. You were the first chief economist that we interviewed as part of our webinar series, starting back in March. And if we think back to what it was like back then, there was massive uncertainty.
Yeah.
We unpacked what that meant. We talked about what the headlines would be doing and saying. We really focused on what the fundamentals are of the property market, predominantly supply and demand, and how that influences markets. We spoke a lot about, and it was speculative at this point, you and I, in terms of what we thought would happen, especially around government stimulus.
Yes.
Given that interest rates weren't a lever that the RBA and the government had to pull on this time around in terms of the pending downturn back then. And we also talked about the fact that we didn't think that there would be a market crash. Yep. There would probably be some slight retraction in the median house price purely due to the top quartile properties not selling at the same volume.
Yep.
And not that we have a crystal ball, but I think it was really good evidence on the fact that if we retain focus on what does drive property market movements, then
yes,
it helps us build a bit of a fence or a brick wall around the market hysteria that tends to run out of control during downturns when there's a lot of fear and uncertainty in the marketplace. So that's why we're back. We thought this is what we talked about. Yep. Let's explore what actually happened since we spoke back in March. And more excitingly, what are you seeing in the capital cities right now, and what does the outlook look like for 2021?
Well, I think, Michael, when we talk about the process, I think it's rather than looking at what I guess was speculated on being a cyclical downturn, which we have seen before, and those downturns are typically driven by high inflation, pushing up interest rates, and that, of course, impacting affordability and prices. Buyers leave the market and sellers leave the market, and we see prices falling. This was more about a freeze. So the market really went into freeze mode with shutdown, as we all did, I guess, generally in terms of our personal and business lives. But that was the same with the housing market, with property markets. It was just like pushing the pause button. And that's why, to a large degree, once the physical restrictions, particularly on property inspections, were eased, it sort of undid the pause button. And we've seen in capital city markets just buyers and sellers getting on with business. And really, it was a sense also of pent-up demand for property. And that's been released quite significantly in particularly Brisbane and Sydney, and also Canberra. And markets Perth and Adelaide are also performing quite reasonably at the moment. And I think that's the real focus, is that we've hit the pause button, then we've released the pause button, and off we've gone again. And I think that, of course, these things have been assisted by significant government stimulus. But I just think really people have treated the COVID situation as a health situation, and it really hasn't impacted I guess the notion of engaging in the property market. And clearly that's the evidence we've seen. And even though, sadly, Melbourne went into a second lockdown, we've seen the same process evolving over the last month in Melbourne. Once we had those physical restrictions to property inspections eased, buyers and sellers really did get back into the market. And it's only a couple of weeks, but the data that I've got now, and I track real-time new listings on a capital city basis, and I also track real-time newly reported sales. And they've surged in Melbourne over the last fortnight and continuing to rise. And it really is a sense of that releasing of pent-up demand. It's just really, Melbourne's an interesting case because it really can, when we speculate on what's to happen in the Melbourne market, we can look at see what's happened in the other capital cities as a guide. And it's occurring exactly the same as we saw it 2 or 3 months ago, starting to rise in those other capital city markets. And I think that's the first point of the exercise, is that to release that pent-up demand. And then, of course, moving into next year, a lot will depend on the economy. But the economy has performed surprisingly well for those that were in the doom and gloom, brigade, predicting 20% unemployment, 30% unemployment. But I think we'll struggle to get a 10% unemployment rate at its peak in this cycle. Of course, we need to keep the health issues under control, and a lot depends on what happens overseas. Of course, we have a very important election coming up next week in the United States. So there's plenty of, queries as to the impacts on our economy going forward. But so far, we've done very, very well. And in fact, our unemployment rate's been falling over the last couple of months and would have fallen again over September, if unfortunately the Melbourne situation hadn't have dragged the economy down, which of course was eminently predictable. So really it's been a pause, a freeze in the market. Markets have dusted themselves off, moved on. It's now quite a healthy spring market environment in all capital city markets. And there's no doubt, Michael, that Melbourne's out and about again. It's up and running even before, significant easing of restrictions, which is likely to occur over the next couple of weeks.
Yeah, it's a good point that you make. When we actually did a weekly video series for the first kind of 6 to 8 weeks through March, April, May of COVID as a client education exercise, just to help them navigate what they were hearing and what we thought it would mean. And we were talking about how the upswing that comes post downturn due to that pent up demand is something that we'd look out for. But I think you mentioned pause is a really good thing. We said that the government would be looking to put the economy on idle. Obviously, the stimulus around JobKeeper and so on has been very strong. And while 7% unemployment, give or take, is higher than obviously what we're used to, it's definitely not as bad as what it could have got, where the speculation was happening. And if we keep it in perspective, it still means that 93% of the working population are employed. And, some of the things that we've been seeing, as I'm sure you have, is when that confidence comes back due to the restrictions being leased, we're seeing that release of the pent-up demand. And because people haven't been able to eat out nor take holidays to the same effect, they've actually got more disposable income in their pocket than what they otherwise would have, yeah?
And it might be a case of it's the new thing to do during shutdown is to look for that next property and be ready to go as soon as you can get out and actually inspect it. But look, it's really been a very positive coming out from those restrictions in the marketplaces, and it really does once again emphasise that this hasn't been a cyclical event. It's been an issue to do with the constraining of moving around, whether it be to work or whatever. And that meant that, the physical capacity to purchase property was put on hold. It wasn't that the appetite was constrained for any fundamental reason, as we see in a sort of a cyclical event, because, when we have downturns, as I mentioned before, it reflects higher interest rates, and that also ends up with higher unemployment. But the real relationship isn't with the unemployment. That's a factor of higher interest rates. And of course, this time we've got the lowest interest rates we've ever had, and of course, likely to fall again over November. The jungle drums are beating very loudly that we'll get a cut. Of course, it's nothing to get overly excited about, because we can really only cut that 0.1% to bring us down to 0.15%, and that's probably just about the end of the ball game for the interest rate cycle. I think the Reserve Bank has has indicated it won't go to zero rates. Now, it's not going to have a significant material effect on affordability, but it's certainly a positive in terms of confidence. It will help at the margins mortgage holders with lower repayments, and it will make property more affordable for those that are taking out new mortgages. So, it's good news there, but it again reflects the different nature of this event, and that is that we don't have the interest rate energy to throw at the problem, which we normally would have if it was a cyclical downturn. It means it's over to governments to provide fiscal stimulus. Certainly the federal government has done all that could be expected, I would suggest, to this point of time, and will do more. But I think the real interesting point, Michael, is now what state governments will do. We are going to get a raft of state government budgets announced over the next month, and it really is going to be interesting to see what they do in terms of stimulating their local economies through increased government spending. And I think we may see some property-focused policies from state governments working around perhaps stamp duty in the first instance. But, once again, it's a positive for the economy that we still haven't had that, that particular driving force into our economy yet from the state government budgets. But certainly I think the federal government can get a tick for what it's done. No thoughts of the level of debt. We're probably in a better position than many or most advanced economies in terms of our prospects. And I think that's what's kept our share market quite reasonable, and also our dollar quite reasonable. That, there is a perception that Australia's not only done very well on the health issues, notwithstanding what happened in Melbourne over the last couple of months, but also the prospects for our economy, I think, are getting a tick from investors both locally and internationally.
Yeah, I think the point you make around affordability and the government debt, and the fact that they've been able to afford to spend what they have in terms of the stimulus is really important. We're actually really excited, just literally hot off the press, our new book, Investing in the New Normal, we've called it. It basically started from Matt, Cam and I talking around our own experiences and those of our mentors through previous downturns and what those kind of key indicators are. Right back to World War II, when debt to GDP was over 120%.
Yep.
And the fact that population growth and as interest rates come down, it effectively costs a lot less to service that debt, just like it does a mortgage as interest rates come down. So I think it's while the number sounds big, given where the cash rate is at record lows, that's really worked to the government's advantage in terms of being able to stimulate the way that they have, and provide a very good outcome, as you've said. What are some of your views on what the state governments will do? You mentioned stamp duty. Is it going to be focused around removing barriers to entry into the property market, or more widespread than that as well?
Well, state governments are restricted to some degree in terms of what they can do. They don't have the big bucket of money that the Commonwealth has. But certainly stamp duty, I would suggest, particularly for property, is a very important lever for releasing pent-up demand. It certainly can assist the development industry by providing more demand, by making property more affordable. I also think that there are actions that state and local governments can do in relation to planning regimes. I think that there can be a little bit more of a rational view in terms of understanding perhaps that we're looking towards a different property model going forward. It's interesting that we've seen a surge in a differentiation, I guess, in rental markets recently, whereby for various reasons, of course, CBD Melbourne now has record vacancies, and inner city Sydney also has record vacancies. Now, there's a couple of reasons behind that. Of course, there's been a lot of stock come into those markets, a lot of investor stock over the last 3 or 4 years. We've seen with closed borders that those landlords that look to holiday accommodation have had to move into the permanent market. That's given more supply into those areas, which are typically Airbnb markets, such as Melbourne CBD and Sydney inner city. We've also seen a lot of supply still coming into the market, new supply. And also, of course, very strong first home buyer activity at the moment means that those first home buyers are buying and not renting. So we've seen reduced demand there. But what we've seen, interestingly enough, is increased demand from the rental markets for larger properties, for houses. And I think what we're seeing is this shift from the work from home environment to people thinking, well, I need more space. I need to think about a larger property. I'm not that attached to a CBD location anymore. So I'm happy to go further out. Now, that means that governments have to start thinking about providing the land that can cater for this change in residential preferences. And that's not just broadacre stuff on the fringe. It's also about medium density properties in suburban locations. We've got to start thinking about creating these home office residences, because that's certainly going to be, the vogue for how we live going forward now, even post-coronavirus. So I think that that's another aspect that governments can look at on the supply side, state governments, as well as what they can do on the demand side in terms of, encouraging demand through lower stamp duty rates, particularly directed to the property market.
Yeah, absolutely. It's isn't it interesting to see that dichotomy between the vacancy rates, where we had our annual client night last week, and we shared this with our clients around how double-digit vacancy rate in the inner city apartment markets. Yet, due to that lack of supply coming on and the increase in demand, as you say, a steep drop in vacancy rates in middle ring suburban median density houses down to, I don't know a suburb that's over 2% off the top of my head, and most of them trending down towards 1% or even under in a couple of cases. So, real kind of difference in the different types of asset classes within the property market.
Yeah, swings and roundabouts, Michael. And I think the shutdown has accelerated what was a home office environment anyway. But it also makes us think about the way we live, what our properties are, and it's accelerating that sense of, how we want to live, livability in terms of the structures we have. And I think it's over to designers and builders, and importantly, town planners to, create that to sort of try to move at least with this new sense of how we want to live, and by providing, on the supply side, appropriate land. And look, this is a good thing, because it can also create that sort of economic stimulus that we require as well. But it is interesting how things have changed, and also, the employment markets. Even though obviously a lot of people are being supported now through JobKeeper, a lot of people sadly have lost jobs. Melbourne's lost over 200,000 jobs in the last 6 months. Other capitals are now starting to see a very solid increase in jobs. People have left the workforce as well. But, in capital cities such as Sydney, which has opened up at a faster rate than any of the other capitals, we've really seen a swing into employment. Even that sort of cafe, restaurant, lifestyle, entertainment employment has picked up very rapidly. I also think that, the whole sense of moving from a bricks and mortar shopfront environment for our retail has created a lot of energy in the distribution and storage through online sales. My buzzer keeps ringing here because my wife's constantly buying stuff. But that's another story. But it's certainly creating work, and I think once again it's those swings and roundabouts, if you know what I mean. It's it's created a demand in a whole other area, and we've sort of through necessity creating these new industries and creating opportunities in these new industries. So I think once again it's up to governments to nurture that. And for us to recognise that this change is a positive thing as well, because it's, we mentioned before about the level of government debt. Australia moved into this COVID-driven recession basically with a budget surplus. And if we compare ourselves to the US had a deficit of 4% of GDP at that time. So this is why we're getting a big tick, and why we can spend and not suffer through a a lower currency, particularly because we've come into this, downturn in a very strong fiscal position. And the point is that all other advanced economies are also having to borrow and stimulate their economy. So in a relative sense, we've actually stood up, even though we are spending at record levels. And of course, the other point that Australia has in its favour is that we've still got that very strong resource sector, Michael, which is going quite well at the moment in terms of iron ore and even coal, but particularly iron ore has had a boom period over the last 3 or 4 months. So we're in that, with a small population, we're in that, I guess, enviable position of having a very strong offshore income with demand continuing, particularly from China, for our iron ore. And, once again, it places us in a very good position relative to other economies to see our way through this recession.
So that's probably a good lead into what you're seeing happening into 2021 and beyond. Because, while we have border closure at the moment, we do have, about 4,000 people returning to Australia per week. And obviously not many people are leaving at all. So the net population change is reasonably positive. But thinking more short to medium term, for all the reasons that you've just said, the economic prosperity, the physical position that Australia are in, the lifestyle that we have here, the way that we've handled COVID, all of the above, while there's going to be a short-term impact on overseas migration when those borders do open up, personal opinion is that we're very well placed to be attracting, more demand into Australia from that point forward. Is that a view that you share, and what are your thoughts on that?
Yeah, absolutely, Michael. I think that we know that we're going to have a big decline in migration. The Prime Minister has said that he believes migration levels will fall by around 85%. I don't think that's going to have a short-term impact on the housing market, as many have speculated. Those long-term population dynamics, or those population dynamics, are more about long-term change in the market. We can see we've had a significant downturn in terms of migration over the past 3 years, and yet housing markets have responded quite strongly. And I think that the housing market activity is more about local population shifts rather than those big picture issues. We're seeing those shifts occur in some capital city markets as a response to COVID. Now, maybe some some states will be looked at COVID safe havens, such as Queensland, perhaps the Northern Territory, which is very strong at the moment. But I don't think that'll have an impact, certainly, on local housing markets, that net interstate migration. But I think we've overstated the impact of international migration. But I think, as you said, and I think the lesson is what we were discussing before, is that we're going to see, particularly as those state borders are opened up, particularly the Queensland border, we're going to see, I guess, the pent-up demand from tourism particularly start to bite. And I think that's once again going to be reflective of, another surge in employment, another surge in economic growth, as people, take those holidays and have those breaks that they've missed out on over the last 6 months. And that'll, pick up Queensland, New South Wales, and even Victoria once the borders are open in terms of business travel. That'll start to regenerate. And again, it's all about the freeze rather than the downturn. And then we see the backing up and the demand rising once the freeze is lifted in terms of the economy, not just the housing market, in those particular sectors.
Yeah, great. So maybe what would be fantastic to hear from you, as an investment strategy, we focus on the 4 major capital cities because price growth is at the most basic level, supply and demand, and you've got the least amount of land and the most amount of people in those 4 major capitals, being Sydney, Melbourne, Brisbane and Perth, obviously. Could you just give us the snapshot on what you're seeing for each of those locations through the next 12 months or so, in your opinion?
Well, if we do stick with migration, Michael, there's no doubt there's been a significant increase in interstate migration into Western Australia and to Queensland. I think these are key drivers of that market. The Perth market has certainly, while still at 10-year lows, is starting to rise again on the back of increased interstate migration. Of course, that will only increase the opportunity for a revival there. The Queensland market, again, is similar to Western Australia, particularly southeast Queensland, is experiencing a surge in migration, interstate migration. Net interstate migration into Queensland is the highest of any of the states. And of course, one of the positives for the Queensland market is, or the southeast Queensland market particularly, are the affordability advantages that it has over particularly Sydney and Melbourne. So I think that we're going to see strong results from Perth and Brisbane particularly. And when I say strong, I'm not talking about double-figure growth here. It will be, something we're not used to in terms of a cycle rebound, because it's not a cycle rebound. It's just an unfreezing. So we sort of go back to where we were before COVID in terms of our price potentials. And I think that, going forward, we're looking at top markets being around about 5%, 6% in growth over a year in terms of capital growth for house prices. But I don't think there's going to be a big difference between the top performers and the underperformers. And I think the underperformers will still get 2 or 3% growth going forward. And of course, the key to all that is that we don't have interest rate cuts to push into the market to push up house prices, which we see in normal cyclical outcomes. So I think, the point is that Melbourne and Sydney had a head of steam before coronavirus hit. The other point to that is the reason they had a head of steam was not just lower interest rates, which is important, of course, but also that prices were still below where they were in 2017. So in Melbourne and Sydney, it's still a great time to buy because prices are still around 7% lower than where they were at their previous peaks in 2017. And this is what clearly drives the market. And on top of those stimulus packages for the budget market particularly, and that's for new builds and first home buyers, I think that we're going to see quite a broadly based demand profile in our markets. But as I said, Melbourne and Sydney still offer a lot of value in terms of them being below their previous price peaks. And I think that's what was driving the market at the beginning of the year. And that's what's going to drive the markets once we completely unlock them, which we're sort of doing by and large at the moment.
You mentioned a couple of things over the last 10 minutes or so that I just wanted to drill into in a little bit more detail. One was government stimulus and the second one was lending and what that meant for affordability. So from a government stimulus perspective, the kind of language that we've been using with our clients is the government have had to obviously go hard on putting the economy on idle through JobKeeper, JobSeeker, etc. But they've had to keep a bit of their powder dry because until things really start to ramp up, that's when the money's going to be needed to continue to drive that economic recovery. What do you were spot on when we spoke 6 months ago or 7 months ago around what would happen. Where do you think we'll start to see federal government stimulus continue to unfold? In which areas, sectors, etc., and what impact will that have?
Well, it's going to be a gradual process, Michael. There's no doubt about that. The government's already extended JobKeeper. And I think the whole point that we've got Victoria now unlocking is such a tremendous positive because it means that there becomes more certainty in the outlook because we didn't have that certainty. And, of course, Victoria is such a strong part of the national equation. But now we can now get on with the business of recovering the Victorian economy. It means that the outlook in terms of reducing stimulus packages is a lot more positive. And, of course, we've seen unemployment rate, as I said, ticked up to 6.9% over September, courtesy of what was happening in Victoria. No surprise there. But we really have seen a strong rebound in our labour markets since the shutdowns ended everywhere except Victoria. And I think that's, obviously something the government's welcoming because once we've seen not just people getting jobs, but also an increase in the participation rate as people start to get more confident about being in the workforce, even if they're not getting a job, they're looking for a job. I think that this means that it gives the government some sense of relief that they won't have to continue with, significant levels of support for the unemployed going forward because jobs are being found. and incomes are being generated. Again, let's not underestimate, of course, the fact that this is still a significant economic event, that a lot of people are out of work. A lot of people, it's been a much more positive result than many predicted or expected. And that means I think that going forward, we'll have an orderly revival of our economy. And we're very fortunate to sort of have that, particularly given what's happening in similar overseas advanced economies. But I do think there'll be an orderly process into the new year. We're fortunate that Victoria can now concentrate on getting its economy up and running and getting jobs created. That will happen, and I think it will happen quite quickly, as experience of other capital city markets has clearly been, particularly in that hospitality sector, which has driven, I think, the early rebound in other economies. And Victorians, Melburnians are noted for their sort of hospitality, their need to be out and about, and I guess they sort of lead the planet, don't they, in that? But so I think they'll be itching to get out and about, and I think there'll be plenty of employment opportunities as a result. And I think it's come just in time. And let's get those borders open, and let's get Christmas happening as close to normal as we can. And I think that will mean that we have a much better outlook for easing stimulus packages next year. I think the big picture stimulus packages need to continue. And that means higher levels of government debt. But I do mean directed fiscal policies at particular parts of the economy. There's no doubt that the property policies have worked. The home builder grant has been a winner across the board. Perhaps we could think about extending that. And also the first home buyer deposit scheme has also been a winner. New South Wales government have had announced that their threshold for stamp duty relief for first home buyers had been lifted. Perhaps we could think about the other governments, particularly the Victorian government, doing that. It's almost an unlimited resource, as you know, Michael, first home buyers, and we should give them every opportunity to get into the market as they all want to. I mean, when we talk about drivers of the Australian housing market, clearly the very strongest driver that we have is the aspiration for home ownership, which is so deeply locked in our DNA that, when it comes to needing economic stimulus, that's got to be the first lever we pull. And all we have to do is see what's happened with, the first home buyer deposit scheme and the home builder grant. And so many thousands of first home buyers are coming into the market now, sort of without, I guess, over concern about the economic circumstances or the market circumstances. I think we need to continue to nurture that through through state government stimulus activities.
Excellent. And when do we expect you mentioned state budgets before. When do we expect the state budget announcements?
Some of them haven't specifically announced timing, but it will be within the next month, Michael. It will be around in November because they have to come. Obviously, Victoria was waiting to get its I guess, health issues under control. They would have gone anyway. New South Wales will go in a couple of weeks, I think. Queensland government, of course, Queensland's in the middle of an election. They go to the polls this Saturday. So they'll be waiting to get a result from the election. But all budgets were put on hold because of the federal budget. They have to wait till the federal budget's been done and dusted, and that's only 3 weeks before, 3 weeks ago. So, within the next month, they'll all come out, Michael.
Yeah, great. And it's been easy kind of down here in Melbourne to be all consumed with the lockdown and so on. But fantastic to hear that in other capital cities, the labour market rebound, the economic recovery, housing demand, especially. I know that we've seen in some pockets of Brisbane, where we're recommending to clients, there's been a 400% increase in land demand since June when Home Builder was announced. So great to hear some positive stories coming out of other parts of Australia and what that might mean for Melburnians moving forward. It's been great to get an update and I guess recap on where we were 6 months ago. Focus on the fundamentals.
Yeah.
And great that the news is a lot more positive than the last time we spoke. The one fundamental that I just want to get your opinion on now is around lending. Obviously, as we know, since Sydney was a runaway market in early 2017, and the lending restrictions imposed by APRA on the banks came into full force, if you like. We've been in a relatively tough lending environment. While that has improved with interest rate drops in the last 12 months or so, there's no doubt that lending is still fairly difficult. A couple of things that have come to light in the last 3 or 4 weeks have been, we talked about pent-up demand, Aussie home loans talking about record volumes of pre-approvals, in August this year. The highest volume since 2014, double the volume that they did in August 2018. And then shortly after that, Josh Frydenberg announced that it was really going to be, the onus was going to be on borrowers rather than banks in terms of that due diligence in terms of what they can lend. So given that will bring not only more qualified buyers, but buyers with higher borrowing capacities into the marketplace, subject to passing legislation in March, it's nice that the timing lines up with the autumn selling season that you were saying. What do you think the impact of those will be, and anything that you can quantify around that?
Well, look, it's from my perspective, Michael, and I've been a vociferous critic of this, it's been cloud cuckoo land in terms of our lending environment over the last 5 years. We're very fortunate in this country. I mentioned one of our key drivers being the aspiration for home ownership and home investment that keeps our housing markets sort of locked in that very positive environment. The other is, of course, our lending environment with the big four banks. They operate as an oligopoly. There is no competition amongst them, but that's a good thing because they don't have to take risks with their lending. But we seem to believe that our lending is inherently risky for some, bizarre reason, even though there's no evidence to support that. And when we did have a market surge through lower interest rates in 2015 and 16, we had the regulator step in and say, well, we've got too many investors in the market, and start to instructed banks to cap off investor lending rather than let the cycle ease as it normally does and let, the supply and demand dynamics take their course. They interfered in the marketplace, and that's had significant consequences going forward, particularly for new build in apartments, which we've seen collapse. We created a culture of negativity, particularly around investor lending. And that sort of came to a head in the Banking Royal Commission last year, which was just quite remarkable. Does anybody remember the Banking Royal Commission? Have any of the recommendations been enacted, which whatever they were? And of course, now we have the government coming out and having to say, well, come on, guys, we need to open up the gates with lending. We've gone sort of too far to the, risk management, over managing risk. And banks have sort of been running around like headless chooks because they felt that there was some, inherently risky environment for lending, which just didn't exist. Now, when you look at the latest data, Michael, we can see there's been very strong levels of owner-occupier lending, record levels month by month. We now are up to the highest level in owner-occupier lending for over a decade. That, of course, validates how strong our housing markets are. And first-home buyers, of course, are also at very strong levels through those stimulus packages. But when we look at investor levels, this is the most remarkable statistic. Investor levels now, even though they have risen over the last 3 months, investor levels are now at the same level as first-home buyers. Now, to have investor lending at the same level as first-home buyers is just really weird. At one stage there, when we did have strong investor lending, it was at the same rate as owner-occupier lending. But this has all been because of this institutional credit squeeze that's been placed on investors since 2015, and which has been carried on by the banks as a cultural sort of outcome, which is quite bizarre because what they do is lend. And the fact is that their prudential lending profiles are as strict as any in the world. And yet we've been, sort of bombarded with these, crazy notions of risky lending, to the point where the government's now had to come out and say, come on, guys, get out there and lend. And I think this is very important that we understand that we are very fortunate to have our banking sector being as risk averse as it is. Yes, perhaps it reflects on some of the management culture. Yes, there's some very high incomes paid there, but that's the cost of oligopolies and lower levels of competition. but I don't care because it keeps our housing market safe. Always has, always will. And that's what I think some of our regulators need to sort of recognise and sort of moving forward, allow banks to do what they've always done. And that's just to work as very solid providers and very risk-averse providers of finance. Sorry, I've been on my hobby horse with that one, but it's a little tough, particularly given the apartment sector is flatlining now, and a lot of that's because investors can't get loans.
Yeah, it's we've all got our kind of horror stories around it. I remember there was going back about 18 months ago, a client has dual incomes, kids had moved out, own home paid off, 3 investment properties fully rented. And it got to the point as part of their finance application that they had to demonstrate their $4 a week social club membership at work was a discretionary expense.
Yeah.
So, it's it'll be nice to see some common sense coming back into that landscape. Yeah. But Andrew, great to talk to you again.
Thank you very much, Michael. It's good to talk.
A more positive chat about the trajectory and how the rest of the country, excluding Victoria, have been in the last few months since restriction eased and what's in place for Melbourne moving forward.
Yeah.
It was great to get your insights 6-7 months ago and help people understand and reaffirm what those fundamentals are, and then focus on the same stuff today in terms of where we're heading moving forward. So really appreciate your time. Great to chat again.
Michael. Yeah, it's Melbourne's turn now.
Bring it on. Thanks, Andrew.
Bring it on. Thanks, mate.
So what some fantastic insights there from Andrew Wilson with regards to what we can expect moving forward into 2021. And as we saw, a lot of his commentary.
Well, hi everyone.
A lot of his commentary focused on those fundamentals, which I talked about prior, which was again what he focused on back in March. So there we have a quick snapshot that you can see there with regards to Andrew's predictions moving forward. He talked about pent-up demand. I'll share some data and evidence with you on that shortly. He talked about the overall economic performance prior to COVID. Clearly, the government's strategy and stimulus for the market to minimise unemployment through JobKeeper, JobSeeker, etc. The healthy markets, the interest rate cut. Now, you probably noticed that we filmed this about 3 weeks ago. Andrew made a few points around stamp duty, some of which have come to fruition. Again, amazing when you know what's going to happen based on history and where the triggers are. He talked about interest rate cuts, which were actually announced going back 2 or 3 weeks ago as well as some of the other state stimulus outside of Victoria, which is obviously the most recent, was announced yesterday. So there we have the key points in summary from Andrew's insights. We're not done there. Everyone hang around. We've got some fantastic data and detail to share with you about what drives these kind of things. So at the most basic level, 3 things determine property prices. So to further simplify down what we went through, supply, demand, and affordability. And I'm going to be drilling into each of those one by one. So let's touch on supply to start with. Andrew mentioned in there that the planning rules, planning regulations might be part of state government budgets and look at ways to be able to free up more property because of the constraint that we have. That's exactly what we're talking about with regards to reduced building approvals and reduced development activity, which we've seen happen as a result of COVID. So again, less supply is a really key driver for price growth when demand is there. Vacancy rates, I want to tap into and just show you the key difference between different types of property. There is not one property market in Sydney or one property market in Brisbane or Melbourne or so on. There are markets within markets, and different asset types, property classes are affected differently with these kind of downturns. Vacancy rates are a really good example of that. So if we have a look here, you can see going back, this is over the last 15 years. The numbers are quite small there, but back to 2005, right up to now, you'll see that at the start of 2020 with COVID, there was obviously a dramatic spike in vacancy in CBD property. Most of those are apartments. Like I talked about at the start, that we were educating clients with, this form of, or this asset class is dramatically affected during downturns. If we look at within Sydney though, a suburban corridor of the Northern Beaches, you can see here that the vacancy rate has dropped dramatically. Now, it's under 3% and has been under 3% or at around 3% pretty much for the last 15 years. That's relevant because 3% is considered to be a balanced market where supply meets demand. But that vacancy rate is now down under 1.5% in suburban areas of Sydney. So again, the headlines will talk about massive vacancy because fear sells papers. The reality is, in the suburban band, mainly focused around families, we have that far more robust experience with regards to demand and shrinking vacancy rates as opposed to massive spikes in the CBD areas. Not to harp on the point, but to give you some variation, have a look at Melbourne. We can start to see again, not as significant, but we've definitely seen fairly consistent increases since early 2020. When we look at suburban corridors, again, down under 1%, and that's been pretty consistent in Melbourne for the last few years with vacancy rates much tighter than in Sydney. Case in point, I was talking to one of our property management team yesterday. There was a property being relet for one of our clients. The first inspection on the weekend, there were 6 applications, not 6 attendees, 6 applications that had come in the first 24 hours after that open. And one of those applicants had actually offered to pay more than the listing price on the rent to secure the property. So these are the kinds of things that we see in a really tight rental market. With vacancy rates dropping, we see rents increasing dramatically. That only improves cash flow over and above low interest rates. Again, supply and demand, but just on the rental side as opposed on the price growth side here. And that's why vacancy rates are a key indicator of future price growth, because there gets a point where it becomes more affordable to actually own the property than rent it, provided you have a deposit. Now, not everyone will have the deposit, so rest assured, investors, there'll still be sufficient rental demand in play. But that's why we look at vacancy rates specifically and why we are really energized about what this data is telling us. So that's on the supply side. If we have a look at demand, demand is basically population growth and comes in different formats. Andrew talked about net overseas migration, and I'll touch on that shortly. He also talked about interstate movements, or what we call net interstate migration. Buyer demand and pent-up demand he talked about, as well as government strategy. Now, this could be probably 2 hours in itself, but a few points that I wanted to share with you that elaborate on what Andrew mentioned. Net overseas migration. Now, it's been made quite public that obviously our borders are closed. Josh Frydenberg announced as part of the budget announcements that the borders would be staying shut and we wouldn't be having overseas migration, at least for the next couple of years. Now, that was taken to mean that our population won't be growing. What is often not reported, Andrew and I talked about those returning Australians, where currently the cap is around 4,000 people per week. Data was announced in the last 48 hours that the number of Australians returning home to Australia since March was actually 389,000. So just to put that into context, our borders are closed, and while there's no overseas migration as we've come to know it over the last 8 years, while the government have committed to this strategy of skilled migration, our skilled migration numbers for each of the last 8 years have been around 200,000, give or take. We've had nearly double that in overseas migration in the form of Australians returning to Australia. I don't have a crystal ball, but I'm fairly sure that most of them would be staying in Australia as opposed to looking to move back overseas, given how we've handled COVID, the lifestyle scenario here, and what that means. And that extends even if we look out in the medium term. I think Australia is going to be a fairly appealing place for people to move to and to live once that border restrictions are eased. So again, remember, we're playing the long-term game here with property. The short-term is appealing. This is why we want to be in now, but make no mistake, and I'll share a graph with you shortly, net overseas migration is another government go-to strategy in the past to bring us out of downturns and drive population growth and economic recovery. Buyer demand and government strategy on population growth. Andrew mentioned both of these things. I want to share a bit of data that's come out in recent weeks. This first one, it was a well-publicised article. You may well have seen it. In short, Aussie Home Loans announced in September that their August volume of pre-approvals was at a monthly record level for any month since 2014. Now, take that to mean that there's pent-up demand. People are getting their pre-approvals. They're getting ready to act. As Andrew said, that strong spring and summer selling season that is typically a strong time in real estate. People are getting ready and buyer demand is increasing. I mentioned population growth and net overseas migration. This is the graph that I wanted to share with you. This comes from our new book, Investing in the New Normal, one that Cam, Matt and I wrote recently, came out from availability out of print about 4 weeks ago now. We're really proud of it. We talk about our insights and learnings over previous downturns. We can't expect over the long term that there aren't going to be pause periods, economic shocks and downturns. But the way that I explain it to my clients is this, and feel free to raise your hand, use the chat if you've got some commentary, that if I was to ask the question, with the benefit of hindsight, would you have bought a property 35 years ago? I am yet to meet someone that says no. But what if I told you 35 years ago that you could buy a property? I didn't tell you how much it was going to grow, but what I said was we would have to endure negative gearing being removed, negative gearing being reinstated. 4 years after that, there would be the recession that we had to have, where we would see dramatic unemployment for several years, double-digit unemployment at the peak, far worse than we've got today with the coronavirus health issue. 6 years after that, we'd have the Asian financial crisis, where international stock markets would lose 60% of their value. A couple of years after that, we'd have September 11. 7 years after that, we'd have the GFC, and then we'd have a really tough lending environment where, as Andrew said, regulators interfered with the natural market dynamics through imposing really tough lending restrictions. How many of you would have been willing to buy 35 years ago knowing that those things were going to happen? So this is why we share this content with you. I'm not the eternal optimist that says that property is going to be going up every day or every week. What I am sharing with you is education around the fundamentals that drive property markets so you can determine the opportunity for yourself and be best placed to be able to take advantage of the growth that we see coming because of all of these fundamentals, as opposed to the uneducated person out there that will look back in 10 years from now and say, really wish I'd bought a property in 2020, but the paper told me that the bank said that the market was going to crash by 30%. Like I said, black and white, guys, but these are the fundamentals on what drives markets. What this graph shows us here is going back over the decades. Specifically, the light grey part is what I want to focus on, which is the net overseas migration in each of these decades. And what you'll notice through the 1950s and 1960s, specifically the 1980s, the 2000s and the 2010s, is you'll see incremental increases in the net overseas migration. Why is that? Because they are the decades after a downturn. Obviously, we had the World War in the 40s. Ben Chifley, the Prime Minister at the time, had a saying, populate or perish. We are in a deficit. Yes, there's some debt that needs to be serviced and paid off in time. The best way to do that is to drive population growth and economic recovery through more people. So yes, the border might be shut for a finite period, make no mistake, we expect that the government will really kickstart the economic recovery with additional overseas migration as we move forward. Finally, the third piece of the puzzle being affordability, specifically interest rates and wages. I mentioned at the start that affordability had improved 40% with the drop in interest rates. Andrew reiterated the fact that markets haven't yet exceeded the peaks of 2017 in a lot of cases, and why it makes sense to be looking in the major capitals like Melbourne, perhaps Sydney. We're more bullish on Melbourne than Sydney. But again, affordability is a key thing to bear in mind. So let's have a look at the things that affect market affordability. There's lending policy, interest rates. Obviously, I'll talk specifically about the lending policy changes and what that means for price growth forecasts, and what the banks specifically are expecting in this patch. Now, how lending policies affect property markets. I would love to have 20 minutes to explain this the way that I do to my clients when I meet with them and when I take them through the factors that influence markets. However, can't do that here. I'm going to give you the short version. Okay, this shows median house price movements up until pre-COVID. So effectively, what we're looking at here, okay, is let's take the Sydney market for example. From 2013 through to early 2017, the Sydney market saw over 90% increase in the median house price. This is the point here where Andrew Wilson was saying that APRA imposed the lending restrictions on the banks, and that obviously reduced the amount that borrowers could borrow. Now, quick reality check here on what a median house price is, and that's pretty much the straightest line I've drawn in the last few days. So we got lucky today. The median house price is not the average property value. That's a common mistake that's made. It is the middle value, which means if there are 5 sales below the median, that must mean that there are 5 sales above the median when they're ranked on price. So here's our median. Okay, now if we impose, or if we have restrictions imposed on lending and that reduces the amount that people can borrow, would we expect a drop in purchase volume at the top end of the market, or an increase in the purchase at the top end of the market? Well, we'd expect a drop, because if people can't borrow as much, they're not buying properties above the median with the same regularity as what they are below the median. As a result, the middle value needs to shift backwards. Now, this is what the paper says is the market crash. It's not a crash at all. The fundamentals have remained quite strong in terms of supply and demand, as Andrew said. It's just that the lending policies have impacted the number of buyers in the market. Let's have a look at what happened at this point here, and why, in almost perfect unison, the Sydney and Melbourne markets rebounded quite quickly. Well, this was around May, June 2019, last year. 3 things happened. The coalition was re-elected to power. That was good for business confidence. Regardless of which way you vote, you might remember that the Labor government was taking the removal of negative gearing for established properties to the election as a campaign. That meant that several investors had been sitting on their hands for some months. Once the coalition was restored, pent-up demand kicked in and we saw a rapid recovery. Couple that with interest rates starting to come down, and also lending restrictions being eased ever so slightly after the Royal Commission findings, and all of those things point to a restoration in people's ability to buy again above the median house price. So a really quick snapshot there on how lending policies influence buyer demand and how that has a direct translation to market movements. It's not a boom, then a crash, then a boom again at all. It's purely how lending influences that. So hopefully that's been helpful for you. If I can work out how to get my, there we go. On the topic of government policy, what we can see here is the evidence on the Josh Frydenberg announcement that I mentioned happened post-budget, or just before budget, I should say, sorry, where the lending restrictions basically are going to be eased. Those massive buffers that are being imposed on the banks are going to be removed, and the onus will become on borrowers to be able to meet their mortgage repayments. I don't need to spend any more time on this. Andrew was very forthright and direct and clear on his belief on what should be happening here, and the fact that it was regulatory intervention. When these restrictions are eased, absolutely the number of borrowers will increase and their capacity will increase. Just to be really clear here, this doesn't mean that the bank's due process is going out the window and they're going to throw money at anyone. People still need to qualify. They will need to meet a serious set of criteria like they always have in Australia. It's just the massive buffers imposed on them are going to be reduced. What does Westpac think will be the impact of this? This was information shared on a call I had with their chief economist a few weeks ago with regards to their price growth predictions over the next 2 to 3 years in the major capital cities. Enough said. I'm not one to crystal ball on the percentage growth, but as you can see, the fundamentals that we are talking about, which is what economists like Dr. Andrew Wilson, like Westpac, other banks, etc., the government, the RBA are focusing on, all of these indicators are pointing to the fact that we are going to see a really strong housing market, really strong demand with price growth to follow in the short term until the overseas migration really comes back and that continues the strength in the market ongoing. So I wasn't underestimating it when I said I feel that in a decade from now, this will be a once in a decade opportunity that we look back on, and those that are focused take advantage of. So this is to share with you what the bank's forecasts are looking like. Now, at this point, I realise I've got a little bit more to share with you, not much. If you do need to take off, because we said around 90 minutes, again, in the chat box, please register for your strategy session. Take us up on that opportunity to be able to share more of this information, more of the investment fundamentals with you, to build that knowledge base and position you to take advantage of opportunities into next year. Nothing to buy, nothing to sign, no cost nor obligation. If you're finding today useful, by all means, take us up on that offer. Bit of a Christmas bonus from us. It'll be worthwhile information being across. So, if this is exciting, like us, you wanting to think about buying, not all property is created equal. There are some properties to be buying and some to be steering clear of. As I said, there's not one property market. In previous webinars, I've shared a 30 to 40 minute explanation touching on our property selection process here at OpenCorp. It's the same process I've used for all of my investments that I've added to my own portfolio over the last 17 years. Matt, Alan, Cam, and our consulting team likewise. In summary, this is the process that we use to give you a really helicopter view on how we identify where we want to be and why this map selection process works. We call it MAP because it stands for Market Area Property. It is a process of elimination where we are looking at which capital city markets make sense at any point in time. If you think of the alternative is to look at property by property and compare property one with property two. Too time consuming. It'd take you 15 years before you bought anything. So we want a process where we can eliminate certain capital city markets that don't make sense for us right now. Once we've got the markets that do make sense right now, we can then use a similar process of elimination to identify the areas, suburbs, growth corridors, principal activity centres that fulfill all of those key criteria under the market section and those additional ones under the area section. I'll just touch on the bottom one there, being abundant owner occupiers. I was a first-time investor once myself. For the first-time investors amongst us that nominated that as part of the poll at the start of the session, I just want to share with you that my biggest concern when I started was, what if I don't have a tenant? I've talked to thousands of people over the last 12 years helping them build an investment portfolio. I would say that 80 to 90% of them, not having a tenant would be their major concern as well. So at OpenCorp, we actually provide guarantees in terms of the time frame to have a tenant secured in our properties. We guarantee we'll have a signed lease within a month of that property becoming available. So this is us putting our money where our mouth is. You receive payment from us in lieu of rent if we don't meet that. Obviously, we've got to be very confident of our ability to be able to identify quality tenants. And identifying areas with abundant owner-occupier percentage is a key part to that for two reasons. Number one, if we are limiting the amount of rental supply, and clearly it's an area in demand if most people have chosen to live there in this particular suburb, that gives us consistent rental demand where we can identify quality tenants with the financial capacity to be able to pay the rent. That's how we've mitigated the rental and vacancy issues that we have during COVID. The second thing is just think about what owner-occupiers do to their homes. They keep them well presented as a minimum, they add value and spend more on their properties. That helps us in terms of being the investment bought for value around owner-occupiers that have spent more, and that pulls the value of our property up. That creates the equity that allows us to be able to repeat the process. Optimum size and quality is some leverage that we are able to get purely because of our relationships in the marketplace. It's not something that you can get dealing with an agent or a seller or a builder directly. That is some leverage that we can create. So yes, we charge a fee for service. Yes, we do everything. We provide some guarantees. But when I say to our clients that we will save you our fee through the efficiencies that we can build in due to our relationships, plus the optimum size and quality outcome, as well as the tax benefit on our fee, that's why our clients tend to partner with us and why we want to be ensuring that they are getting results so that they come back, as I said earlier. Speaking of results, I mentioned that our MAP process works. We're very proud of it. Going back a couple of years now, we had to make a submission to ASIC as part of our Australian Financial Services licence around our track record. When we look at the performance of our clients' portfolio compared to the performance of the Australian capital cities on average, we achieved significantly better return where we beat the market by 37%. Okay. We don't have a crystal ball. We do have the MAP process. So I'd really encourage you, all of you out there, to think about where you are buying. Please don't be emotional about what you invest in. The property that looks amazing around the corner from where you live probably gives you a bit of comfort because you can drive past it every day. I'm sorry to be black and white, but I don't know a property that goes up in value any quicker if you drive past it every day. Apply a proven set of criteria and a process which we can expand on during our individual strategy session, that personalised strategy session for you, to show you our full range of criteria and exactly how we get the outcomes that we do. So to this point, let's look back on 2021 and the decisions we made in 2020 with happiness and excitement. There's a fork in the road right now. There will be those of you that see the opportunity, that have taken on the information I've presented, that Andrew Wilson's talked about, and the fundamentals that you now understand drive property markets. We are really excited about what the next decade holds, especially the next 3 to 5 years in property markets. Property doesn't go up every day or every week, but absolutely you want to be in the market, taking advantage of that when the markets go up. On the flip side, you can read the paper, be put off by the negativity, wonder what if, or you can be very clear on your long-term plans. You can share those with us and we can sit down with you one-on-one to understand what it means for your individual situation, what's possible right now, and whether or not we think we can help you achieve your financial goals through our strategy. I've really enjoyed talking to you today, wrapping up our webinar series for 2020. If you're a first-time viewer, thanks for tuning in. I hope you found it insightful and valuable around the opportunities right now. If you've been following us throughout the year, tuning in every month, thanks for your support, for your feedback. It's been really positive, and we've loved bringing all of this content to you to be able to get ahead of the curve, be well placed in the market, and be mitigating your risk during the COVID health scare that has been pretty uncertain. But as we can see, when we know what the fundamentals are, we know how we can mitigate that risk and how we can benefit. I'm happy to take some questions now that Abby's been compiling for us in the background as they've been coming in. So thank you very much for your input, and we look forward to seeing you in 2021. Have a very safe holiday season, a happy time with your family, and we'll see you next year.